Hello, this is Joseph Gillette Sr., and I want to talk about the basics of venture capital, what it is, and investing in private markets. Basically, venture capital is investing in someone's idea, project, or venture. And that could be a new company, it could be a product, it could be an idea like exploration, exploring Antarctica, for example, or some foreign place like Christopher Columbus did a very long time ago. Ideas need capital, and investors need ideas because traditional markets only return a certain percentage. I don't want to say any numbers, but for the purposes of this video, let's just say 5 to 10% a year is kind of a stock market average that it can return. That's fine, but for investors who want more risk and potentially more return, they have to look at things like private markets investing. And it is very risky, so for that reason, it's only allowed for accredited investors, with a few exceptions, such as crowdfunding, which is for anyone. Most venture capital investing, however, is for accredited investors only. And usually the investors are big investors, venture funds that have billions of dollars and that have a lot of experience in doing this type of thing specifically. Although you have to be accredited to invest in most private markets investments, there's a lot of ways to get involved in startups, which we'll get into later in the course. But for now, the point is I wanted to explain in broad terms, what are private markets? Private markets are simply a private exchange of value, not a regulated physical exchange like the NASDAQ or the New York Stock Exchange. Let's say it's your neighbor wants to start a hot dog stand or a lemonade stand, but they need $50,000 to get a food cart. You give them the $50,000, and then you have some agreement, like you're going to get half the profits or all the profits. Whatever is your agreement, the point is, that's the essence of private markets, small businesses and venture startups. Now, although it's risky, a lot of the companies in private markets are doing some very interesting things because capitalism is the best balancer in the market. In other words, if you have a really idiotic idea, like I knew a guy that he wanted to have a knife sharpening business, and he bought a truck, and he put a knife sharpener in the back like a big stone, and he thought he would go around to people who use knives and sharpen their knives, coming to people's homes and sharpening their knives. It's a ridiculous idea. If you have a ridiculous idea, it's not going to work. It's going to fail. The market will give you the full test of if your idea is good or not. Investors know this, and they try to figure out which idea is going to be the next super success. And of course, no one knows. But by participating in private markets, by doing the research, by doing the work, by investing in bright ideas, by investing in strong teams and people who are trying to change the world or create value, you have a chance at participating in that huge success one day. And that's what drives most investors into these markets. And because of the risk, that's why it's for accredited investors. So don't think that this is a get-rich-quick scheme. It's definitely not. If anything, it's a get-rich-very-slowly scheme. You have to have a lot of patience. You have to have knowledge. You have to have commitment to the process. And you don't have to commit all your funds. In fact, some people say you should only invest 5 to 10% of your overall portfolio in private markets, and that's good advice. But regardless of what the number is, the thing to understand is that it's a private market. So if you invest in a private company, there's no liquidity. You may never be able to sell. You can lose all your investment. You may lose 100% of your investment. But that's okay. That's what private markets are about. You can make 5,000% return on your investment, possibly. Or you can lose 100%. It's just like that. But it's not traded on any exchange. So let's say you invest in a private company and a year goes by and you want to buy a house or you need liquidity. You can't press a button and sell like in public markets. Private markets, you don't get any information. Public markets, you get tons of information. Apple stock, Tesla, you can look up their SEC filings and you can find out almost anything you want to know about the company, its main executives, and so on and so forth. So investors should be cautious about private markets, but it's not the type of risk like trading futures or going to a casino. You're investing in real companies, in real people who are developing things. So find a story that resonates well with you and stick with that. Learn about it, communicate with the company. They're usually very open to communicating with investors or really anyone about what they're doing. And we'll discuss some other ways you can get involved in venture capital without investing. But I think we've gone over what are private markets, what is venture capital, and how it's different than other kinds of investing.